That's why we are going next to see what are the type of markets. So we have a couple type of markets. We have indices, index, forex currencies, metals, crypto, energy. So this is the markets. I think we can add here stocks, which everyone knows. For example, Tesla, Nvidia. You are buying stocks and you are buying shares in a stock, and hopefully the stock goes up or goes down depending on your trading analysis. You have indices. Indices are calculating based on stocks. So for example, the S&P 500, which gathers all of the 500 best stocks of the US market, and it averaged it down and became an index. So you can trade indices instead of stocks. You can trade forex and currencies, meaning you can trade dollar to yen, for example, USD GPY. You can trade USD GPP, Euro USD, and so on. You have metals, so like gold, like silver, and so on. You have crypto, all of us know crypto, for example, BTC, Bitcoin, Ethereum, Solana, and everything else. You have energy, so like US oil, so oil, and all other types of energy. So each one of these type of markets or instruments inside of those can be traded on spot, futures contracts, or CFD contracts. So in spot, you are buying the exact instrument. So you are buying gold, you are buying stocks, meaning you own the stock, you own the instrument. For example, you buy crypto on spot, meaning you are owning the exact instrument. For example, you buy crypto or you buy Bitcoin on spot, meaning you own now Bitcoin. You have Bitcoin in your possession. This is spot market. Most likely, people who buy in spot are most likely either investing or have a big capital, especially in crypto and in stocks exactly. Now we are going to talk about futures and CFDs, which are most likely what you are interested in, because if you are going to day trade, especially using prop firms, and you don't have a big capital to start with, this is what's going to be interesting for you. So let's start with contracts and different prop firms. Don't worry, this is not complicated. There is two types of prop firms based on type of contracts, which I explained. You have CFD prop firms, meaning you trade CFD contracts, and you have futures prop firms, which is future contracts. You trade the same markets and instruments. Not all, but it's a little bit different. It's not a big difference. So let's say you have gold. You can trade gold on CFDs and you can trade gold on futures. So the chart itself will not change really. It wouldn't be a big change. For example, we have CFDs here, we have gold on CFDs, and you have gold on futures, which is the same a little bit with just a minor differences. So you trade the same market and instruments. So the market is the same idea. So just 4 things change underneath it. So the instrument, let's zoom in more. So for example, on gold CFD, it is XAU USD, which we saw here, XAU USD. For futures, it would be GC1. So GC for futures, or MGC for micro contracts. So oil, for example, in CFD is US oil. On futures, it is CL or MCL for micro. On forex, for example, you have Euro USD. On futures firm, it's 6E or 6B for GBP USD. For indices, for example, US 100, it is NQ on futures firm. So where the price comes from? On CFD, your broker sets it. So it mirrors the market, but it's their but it's their fee, their spread. So the broker sets the price. On futures, the central exchange sets it. So everyone worldwide sees the identical price. So on CFD, you can have multiple brokers, and some brokers can have some minor differences, like very, very low. But it can be some differences on spread. So how you pay to trade? On CFD, you pay by the spread and overnight swap, and some broker add to it commissions. So you have the spread. Spread is just the difference between, oh, this is going to be a little bit technical. Just say that spread is just, for example, you buy at this price. In reality, you buy just above it by a little. So the cost will be different depending on the time frame. So if it's the 1 minute, 5 minute, the cost would be a little bit higher. If it's 15 minutes and higher, the cost will be very low. You have overnight swap, which is fees when you are holding overnight, meaning you are holding multiple days. They charge you a swap fee. The swap could be even positive depending on what you buy. So it can be, you can make money by the swap. Futures, you are paying a commission per contract. So there is no swap, no spread, but it would be very hard to hold overnight, especially if you are trading with prop firms, which you can't hold overnight. You need to close your position. So how your size? So CFD, you have flexible lot sizes, scale to almost anything. So, and you have bigger leverage. So in CFDs, it's very easy to risk a fixed amount of size. In futures, there is fixed contract size, which is why micros exist and matter for small accounts. So you have micros, which you can risk less size than in normal contracts. So you have normal contract and you have micros. So micros, so for example, let's say you have GC. GC, you'll have one contract would be risking higher than MGC. MGC will have a micro contract of GC, meaning that you are trading a smaller contract. So one contract, you risk a fixed amount. And we are going to move to the rule book of the CFD prop firms and the futures prop firms. So CFD firms, you have FTO, MOAF, FUNDEDNEXT. These are some popular ones. This is just examples for now. So can usually, so CFD firms, what are the rules? For example, can usually hold overnight, which is good. So the drawdown is fixed, no activation fee. So you don't have to pay a fee to activate when you pass, but you pay spread. So you have some fees and swap, and 1 minute scalping is harder due to spread. So you can't really scalp that much. It's very hard to scalp. You're going to pay a lot of fees that will take a lot of your profit. Then you have futures firms. You have examples of Apex, my funded futures. They have low commissions. Scalping is fine, so you can scalp on 1 minute and lower. Payouts often smoother depending on the firms, but usually no overnight hold. You can't overnight hold. You can't swing. And you have trailing drawdown, plus some firms add a buffer, meaning, let's explain the drawdown quick. So let's say you are starting with an account of $1,000. To reach your objective, you need, this is just an example, it's not reality, you need to reach a 5% profit. If you lose 5%, you lose the account. In CFD prop firms, this 5% is always here. No matter you go above or even below, it stays in here, 5%. So it would be, if I'm not wrong, 95,000. So it will always be 95,000. If you reach, your account reach 95,000, so the balance becomes 95,000, you are losing your account. On futures, the more you make money, this one is raised. So if you make 2% here, it will be raised here. And so, meaning if you reach 2% and you go just here, your balance becomes this, you lose your account. But CFD prop firms, even if you reach 2% and go down here, nothing will happen until you reach 5% here and you lose the account. That's the difference. You have, for example, a profit target of 8%, then in phase 2, 5%. Your maximum loss is 10%. This is CFD, so the max loss 10% is fixed, it's not trading. You have a daily loss of 5% and so on. When you get funded, you succeed on the challenge and you get funded, you get 80% of the profits bi-weekly. Great.